Hello Propenomix people, and welcome to the longer form explainer video, day 3 of the Propenomix Advent Calendar December 2023, and today I'm talking about the ICR, or the Interest Coverage Ratio. So what is the ICR? Well, this is a concept that was introduced into the property world many years ago and is common across the investment world, but was tweaked in 2017 by the PRA, which is the Prudential Regulation Authority, the sister arm of the FCA, the Financial Conduct Authority. So what does the ICR measure and what does it regulate? Well, an ICR requires to be 125% in order for a lender to make a loan. So what does that mean? It means that if a lender wants to make a loan against a property at a fixed rate, then it will only lend a mortgage that will cost £1,000 a month to pay in interest, because we're only talking about interest here. It will require there to be a rent of £1,250, which is 125% of 1,000. So very simply put, you need to add a quarter back onto the mortgage, or you could look at it the other way around and say the mortgage can only be 80% of the rent. Now this is interesting, because apart from anything else, in the big wider world of investment, analysts might be looking for a much larger interest coverage ratio for servicing debt. So you can, I'm sure, see the problems with only having, with spending 80% of your rental income, which is effectively what you're talking about, on the debt service. And remember, it's only servicing the interest. It's not paying back the principal. So normally in the wider world, analysts would want a coverage of more like 200% or similar, or perhaps 300%. So they would want to double or treble revenues for interest servicing debt. And that would be much more likely. Now, how can it be so different in business than it can be in property? Well, there are a couple of things that make sense. Number one, property goes up over time. It's dragged upwards by inflation. It's dragged up by wage rises. It's dragged up by all sorts of other stuff, right? So you have got two very simple ways in which you gain money from property: rental income, and then also capital growth, which of course you don't realise until you either refinance the property or you sell the property and pay the frictional costs and the taxes that are due. But that is your second and quite often more significant stream of income, and a lot of the point of holding property. So it's an appreciating asset, whereas a business on its own over time is not necessarily an appreciating asset. In fact, it might well be a decaying asset if significant investment and time and effort and governance are not put into it. So that is one of the big differences that you're looking at there. But still, let's look at the likelihood of this being particularly viable in the current environment. So if we use our example of £1,250 a month rent, let's say you use a letting agent and they charge you the market rate, roughly around the country, of 10% plus VAT. So that would be £125 plus VAT of a further £25 on top of that. That's £150. So £1,250 comes in, £150 goes out to the agent and to HMRC effectively. That leaves you with £1,100. And the rent, the mortgage is £1,000. So that leaves you with £100 only as cash flow. This is before you've paid for electrical certificates, gas safety certificates, insurance, and of course, any major or minor repairs and maintenance that need to be done. Now, £100 doesn't sound like a big budget for that in this day and age, does it? So you could very, very easily, and I would suggest you would find yourself, especially if you're not particularly hands-on, losing money if you were looking at an interest coverage ratio of 125% across your portfolio. So I would strongly advise you against, and I've believed for many years, this is an insufficient metric in terms of properly measuring banks' risk, apart from anything else. Now, it's only 125% over the course of 5-year terms or longer. Right, you do have to bear that in mind. Otherwise, it's 145%. So if we went back to our same example, you would need a rent of £1,450 in order to be able to borrow that mortgage that costs you £1,000 a month. And actually, recently, because 2-year bond yields and swap rates have been so much higher in the recent economic cycle and this hiking cycle upwards of rates, actually banks haven't even been willing to lend to that 145%. They've wanted more coverage because they've used what is called the stress test, which is applying the ICR, or the interest coverage ratio, to the rents and saying, right, after this 2-year mortgage has expired, what if the rate is 8%? Then where's the interest coverage ratio? And are we going to be broke? So that's the bearish end of that. Now, let's then look and go back and think about where the positive side of that might be. Well, in a 5-year situation and the 125%, we're only doing that calculation at year 1. And this is critical because if you're in an environment like we're in at the moment, where a lot of commentators are saying that rents could go up 25% within the next 3 years, 35% within the next 5 years, I think that might be at the top end of where I'd be forecasting, but it's very possible that that will happen because of the broken state of the market at the moment. Then, if we try and apply those numbers to our £1,250 rent example, then even if rent went up 20% in those 5 years, and of course it would, let's keep it nice and simple as much as we can, and say that rent rises at 4% every year, well, you're talking about 50 quid a year on £1,250, because 1% would be £12.50, 25, 50. So we're doing £50 rent rise every year, and let's just keep that £50 rent rise the same. So in our first year, we've only got £100 before maintenance and compliance costs, but then in the second year, we've got £150 a month, and in the third year, we've got £200 a month, then we've got £250 a month, and then we've got £300 a month. And that's using a lower forecast of rent rises than is currently out there in the market. So again, it starts to make sense again. But you are betting realistically on capital growth within those 5 years, which of course isn't completely guaranteed. There are points in the UK property cycle in the past where there have not been capital growth. And this is before we've even started to consider arrangement fees and the likes. But don't worry, tomorrow I'm going to be doing the explainer video on arrangement fees, and particularly why they've been so high this year and why high fees might not be a bad thing, but also what you're trading off when you consider some of these high fees and the position that the banks are putting themselves in. So that'll be tomorrow's video. Thanks for tuning in again. Please like, share and subscribe if you don't already. Thank you.